Three separate bills just moved against you and your house in the same week, and nobody's connecting them. Nobody's putting the dots together. This is what a squeeze looks like before anyone calls it one. Utilities requested 18.6 billion in rate increases. Mortgage rates just jumped to their highest level in almost a year. Buyer affordability slipped for the fifth straight month. Now let's get into this.
Here's the headline, July 14th. Utilities request $18.6 billion in rate increases in first half of 2026. $18.6 billion. And that is only the first 6 months and only the requests. 3 bills moved against your house this same week, and I'm covering all 3. Watch this. That headline is not some utility industry story for people in suits. That is the electric bill on your kitchen counter. That is the payment notification on your phone. That is the retired couple trying to decide which bill gets paid first when the air conditioner has to stay on. Utilities requested $18.6 billion in electric and gas rate increases during the first half of 2026, according to Power Lines, a nonprofit that tracks utility rate cases. The second quarter alone hit $9.2 billion in requests. More than 56 million utility customers could be affected. And the problem is not just that bills are high. The problem is that households already behind are being asked to absorb another permanent increase before they have recovered from the last one. 1 in 6 households is already behind on utility bills. Average bills are up 26% in 5 years. So when people hear rate request, they think paperwork. But the family at the kitchen table hears something else. They hear less room. The walls of the household are closing in. Less room for groceries, less room for the car repair, less room for the credit card payment, less room for the emergency that always seems to show up right after the bill does. And these are not all final approvals yet. These are requests moving through state public utility commissions. That is the state regulator that decides how much an electric or gas company is allowed to charge. Most families will never read the filing. They will not sit through the hearing. They will not know the docket number. They will just open the bill later and wonder why the new number feels permanent. Utilities say they need money for an older grid, storm damage, fuel costs, equipment, and new demand. Some of that is real, but a retired couple does not experience grid modernization as a policy debate. A small restaurant owner does not experience transformer costs as an abstract infrastructure issue. They experience it as a monthly payment that shows up whether business is good or bad. You can cancel a streaming service. You can stop eating out. You can delay a vacation. But heat, air conditioning, refrigeration, water, and basic power are not optional. This is how permanent inflation sneaks in. Not one giant national announcement. One approved rate case at a time. My prediction is that second half requests push the 2026 total past $30 billion. The only break most households ever see is the public comment window at the State Utility Commission. If you miss that window, the next time you notice the issue, maybe when the higher bill is already due. Story 2, mortgage rates jumped to highest level in almost a year. That headline ran July 16th. And the payment shock moved from the utility bill to the house payment. The average 30-year fixed mortgage rate rose to 6.55%, the highest level since August 2025. A household now needs roughly $109,000 of income to qualify for the medium-priced single-family home. Purchase applications fell 7% in 1 week. That means buyers did not just feel worse, they stepped back. And if you have been waiting for rates to fall, this is the part that stings. The buyer waiting for relief just watched the payment move farther away again. Everyone waiting for the cut just watched the window move. Mortgage rates do not simply obey a political speech or a Federal Reserve press conference. The Federal Reserve can influence short-term interest rates, but mortgage rates often move with the 10-year Treasury yield. So when oil prices jump, when Middle East tension flares, when traders worry inflation could come back, the mortgage market can move before the average buyer understands why. That is the danger.
Hey everyone, real quick, I created something called the Money Mindset Mastery course. It's a framework for absorbing permanent bill increases without letting them turn into debt on a credit card. If you want to learn more about this, how to think completely different about money for the rest of your life, links down below. I highly suggest it. Now let's get back to the video.
You might hear that inflation is cooling and think the house payment is about to get easier. Then the bond market prices in the next risk before you ever see it in your grocery receipt. A buyer who qualified in January may not qualify in July. A family that could stretch 6 months ago may now be locked out. A landlord looking at a small rental deal may watch the cash flow disappear before the offer even gets written. And sellers are not safe either. If buyers cannot qualify, sellers sit longer. If sellers sit longer, they cut prices or offer concessions. If builders cannot move inventory, they start offering rate buydowns and teaser payments. That is why you will probably start seeing more payment-focused advertising. Not because the market is healthy, because the payment is the problem. Do not build your household budget on a rate cut that has not happened yet. The market does not care what you hope the Federal Reserve does later. The market prices risk now. Last one. Homebuyer affordability slipped for 5th straight month. That headline ran July 17th, and now the story moves from the monthly payment to the future housing supply. Homebuyer affordability slipped in June for the 5th straight month based on the National Association of Realtors Housing Affordability Index. The median single-family home price was $446,400. The income needed to qualify was $109,152 in June. In January, the income needed was $93,552. That is a $15,600 jump in qualifying income in 5 months. The house did not have to double in price to push you out. The payment just had to move faster than your paycheck. And now, the pressure is spreading to builders. Builder confidence fell to 34, a 15-month low. When builder confidence falls, it tells you builders are getting nervous about current sales, buyer traffic, and the next few months. Affordability breaks first, supply breaks second. When buyers cannot afford the payment, traffic slows. When traffic slows, builders protect themselves. They offer incentives, they buy down rates, they delay projects, they build fewer homes than the market will need later. That creates the next problem. Today's affordability crisis can become tomorrow's shortage. So watch the incentives. If you start seeing 4.99% teaser rate ads, closing cost help, free upgrades, and aggressive buydowns, understand what that means. Builders are trying to protect volume without admitting the real payment has cracked. That is why the 3 stories belong together. The utility bill is being reset through filings. The mortgage payment is being reset through rates. The future housing market is being reset through builder confidence. 3 different bills, same household, and none of them asked permission. If your utility bill is already tight, find your state Public Utility Commission website and look for pending rate cases from your provider. If you are shopping for a home, stop pricing the house first. Price the payment first. If you own rentals, watch the same payment math your tenant is watching. That is the word people need to hear. Margin. Your household has a margin. Your business has a margin. Your rental has a margin. These bills are coming for that margin one at a time. The most dangerous bill is not the one that shocks you once. It is the one that quietly becomes normal. The bills do not arrive all at once. They arrive one approval at a time. Economic Ninja is out.